Which T-bill yields are soaring right now? Plus, what other Treasury buying opportunities should you look out for? Hello, member super savers and bond course fans. I hope you're healthy and well. Just as the fighting between Israel and Iran seems to have wound down, at least for the time being, after President Trump's ceasefire announcement, we have two more upcoming deadlines ahead of us that are making financial markets a bit nervous, and at least one of which may create buying opportunities for some of you in our Diamond NestEgg community. So, with that in mind, here are the three topics that we'll be covering in today's video. 1. What important deadlines are on the horizon for our government, and which T-bill yields are on the up and up currently? 2. What other opportunities might emerge in the Treasury market in the coming weeks? And 3. Which Treasuries rose the most, and which ones fell this past week? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. What important deadlines are on the horizon for our government, and which T-bill yields are on the up and up currently? The first important date is July 8th. This is the deadline that President Trump gave our trading partners for striking tariff deals with the US. At this point in time, we haven't seen many agreements yet, and the threat is that the full so-called reciprocal tariffs may come back into force if nothing happens by July 8th. But President Trump might also just extend this deadline to prevent too much disruption, as he's done before and hinted he might do again. We'll keep watching the space, so stay tuned for more developments. The second deadline, though, may be the more critical one, as President Trump can't simply extend or waive it on his own: our debt ceiling. In order for the U.S. to not run out of money, Congress needs to pass the One Beautiful Bill Act, or OBBA, that would decide both next year's budget and increase the debt ceiling. As the next step, Senate Republicans have said that they want to pass their version of the OBBA by July 4th. And from what we can see, the negotiations seem to be in the hot phase at the time of this taping. This debt ceiling deadline had already pushed normally stable 8-week T-bills up from 4.36% on June 9th to as high as 4.58% on June 18th. Now, in this past week's auction, the 8-week T-bill came in a bit lower again at an investment rate of 4.482%. But this is still significantly higher than its 4-week sibling, which came in at 4.068%. The 6-week T-bill also auctioned off at an abnormally high rate of 4.505%. As we mentioned in last week's update video, this 6-week T-bill auction was the first one that would mature in August, putting it squarely into peak debt ceiling deadline negotiation season. It seems that the market expects the final showdown over the budget and the debt ceiling to happen in the first half of August, and is demanding a risk premium in the form of higher yields for treasuries that will mature during that time frame. So, congratulations to our members, super savers, and Diamond NestEgg regulars who did pick up some 6-week and 8-week T-bills in recent weeks after we started reporting on these higher than normal debt ceiling driven yields, what we refer to as blip yields here on the channel. And if you miss these blip yields, no worries, you may still have a chance this coming week. At the time of this taping, here's the expected yield for the upcoming 6-week T-bill auction on Fidelity's platform. And here is the expected yield for the 13-week T-bill auction and the 26-week T-bill auction, which are more in line with market expectations, given that they will mature after the August debt ceiling deadline. There are no other longer-term treasuries on the upcoming auction schedule, which brings us nicely to the next section of today's video. What other opportunities might emerge in the Treasury market in the coming weeks? The Treasury announced this past week that until the debt limit is suspended or increased, debt limit related constraints will lead to greater than normal variability in benchmark bill issuance and significant usage of cash management bills, CMBs. And what this means in concrete terms is that we can expect more CMBs and less normal treasuries being issued over the next few weeks or months. The Treasury expects to issue a series of CMBs over the next month for up to $250 billion in aggregate, Treasury expects that issuing these CMBs will at least partially offset the anticipated reduction to the net supply of Treasury bills associated with shrinking 4, 6, and 8-week benchmark bill offering sizes. And the first such cash management bill to be auctioned off was this 77-day CMB, which was announced last Tuesday and auctioned off last Thursday. But why would the Treasury issue more CMBs and less regular Treasuries? Do CMBs not count against the debt ceiling? This appears to be a top-of-mind question for some of you. And the answer is that CMBs do count against the debt ceiling, just like all regular Treasuries. But CMBs give the Treasury much more flexibility because they can be issued at short notice and in any maturity the Treasury likes, whereas regular Treasuries have both a set auction schedule and defined maturities. Let me explain what I mean. Since January 21st of this year, the US has already technically been up against the debt ceiling and has been using what the Treasury calls extraordinary measures. In a way, our government currently manages its finances like an over-indebted family would do if they had maxed out all their credit cards and couldn't borrow anymore unless they got a higher limit. The Treasury basically dips into any cash savings it has left in the bank. For example, by running down the Treasury General Account that the government has with the Fed. They stopped paying into retirement savings accounts and used the cash to pay for current living expenses. For example, by suspending investments in the Civil Service Retirement and Disability Fund and the Postal Service Retiree Health Benefits Fund. And the Treasury is also timing their cash flows very precisely to make sure that they pay their bills right after the paycheck comes in, so to speak, but not before. For example, the CMBs that the Treasury is auctioning off this week will mature on a Tuesday or Thursday in the second half of September, after the mid-month corporate and non-withheld tax due date, which means the CMB's maturities are set precisely so that they can be repaid with the tax prepayments that companies have to send in September. Now, as we can see, this is all getting a bit tight, and no one knows exactly when all these extraordinary measures will be exhausted. But even if that happens before the OBBA gets signed into law and the government has to go into a partial shutdown, I personally remain confident that the government will keep paying Treasury holders everything that's due even during a shutdown, as administrations from both parties have always done during all past shutdowns. As the saying goes, this isn't our first rodeo. But of course, I don't have a crystal ball either, and we won't know for sure before it actually happens. So with all the upcoming CMB auctions that may take place, I do think that investors who are comfortable with the risk should keep their eyes open for some more of those higher than normal debt ceiling driven blip yields on CMBs with maturity dates around the expected time for a possible government shutdown. Remember, CMBs are really very similar to T-bills in many respects, so I would expect their yields to stay very close to comparable T-bills. Bond beginners, folks, please refer to Module 4 and specifically this video here for more details on cash management bills and how they're similar to and different from T-bills. If you're not in our bond courses, I've linked this CMB video from a while back in the first pinned comment below for you. CMBs are usually available for purchase on Fidelity and E-Trade after the announcement date, but not available on Schwab and Vanguard. So, now that we've covered which T-bills and CMBs to keep an eye out for if you're looking for higher yields, let's move on to the next section of today's video. Which treasuries rose the most and which ones fell this past week? Here's our usual table with treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. The 1.5 month was up for the week on debt ceiling concerns, as we just discussed extensively earlier in the video. The 3 month was unchanged. All the other maturities were down for the week, with the biggest drops in the medium-term notes, as you can see here. Now, there is still a certain degree of volatility in the market, such as when the 1 month briefly fell to 4.11% on Thursday before recovering to 4.19% on Friday. But overall, we interpret this week's data as one more sign that investors might not be exactly fleeing from treasuries. Rather, they continue to buy across a wide range of maturities, with just the exception around the expected debt ceiling crunch time, as we discussed earlier. And even the 8-week, the 2-month, appears to be coming down slightly from its peak blip levels the past 2 weeks, as focus shifts to the 1.5 month. It may be that some parts of the market are expecting most of the debt ceiling saga to be over by the end of August. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Again, increases in rates are shown in black and decreases in rates are shown in red. So the big picture against the beginning of the year hasn't changed fundamentally overall since last week. The 1.5 month through the 6 month, as well as the very long dated 30-year T-bond, continue to be up for the year so far, while the 1 month and the maturities between 1 year and 20 years are down, with the biggest drop still to be seen in the 2-year, 3-year, 5-year, and 7-year. And to say it one final time, the large drop in the normally more or less stable 1 month shows that many investors may still be piling into this short-dated T-bill in times of high unpredictability. Now, as we all know, these are somewhat crazy times we live in, and as always, things could change very quickly. So as usual, we'll keep our eyes and ears on the situation and keep you posted as things evolve. Keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's Daily Treasury Par Yield Curve Rates page. All sources are linked below in the first pinned comment. And as always, if you want to learn more about bond investing and building out a bond portfolio while rates are still attractive, then check out this video here on our bond courses. And for those of you who are looking to diversify your portfolio further during these unpredictable times, this latest member video here on the best international bond funds to buy may also be of interest. I've linked all the details on our bond courses and our YouTube Super Saver membership below this video for your convenience. All right, member Super Savers and bond course fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.